Subscribe to the channel and click on bell icon for continued updates.
Income from house property, quick revision. Section applicable, charging section. 22. 23 will give you GAV. GAV you can arrive it by calculation of municipal valuation or fair rent subject to standard rent. That is the step number 1. Expected rent, higher of MVFR subject to SR. Step 2 is remaining. Actual rent. If we have the concept of unrealized rent or vacancy loss, we use annual rent. From annual rent, you can reduce your vacancy loss. You can also reduce your unrealized rent as per rule 4. If your step 2, that is your actual rent, is less than step 1 because of vacancy loss, then step 2 is your GAV, even if it is less than step 1. Step 3 is GAV, gross annual value, which is higher of step 1 or step 2. From GAV, you can reduce municipal taxes. You will arrive at NAV. From NAV, you can reduce deduction under section 24. 24A being standard deduction at the rate of 30% of NAV. 24B being interest on borrowed capital. Over here, we assume the house property is let out because we took municipal taxes deduction. Okay. So we talk about earning capacity of a house property. The assessee should be owner during the previous year. That is more important. That it is not important that he was owner. He is owner or not owner in the later of the years or assessment year. Correct. 3 types of house properties: self-occupied, let out, deemed let out. Self-occupied is also, you can call it as unoccupied. That means it is used basically by that assessee. Is it okay? Use or not use, but important, not let out. That is self-occupied. Let out means compulsory there is a tenant. The landlord might be earning income of rent from there. But deemed let out, that concept will come into picture only in case of at least 2 house properties and both of them are self-occupied. In that case, one has to be, only one you will consider as self-occupied. So for deemed let out properties, you have to now pay tax on it. Is it okay? Fine. So for municipal taxes, we can take deduction from SOP properties. No, we can take only from let out or deemed let out properties. Okay. GAV in case of self-occupied property is nil. That's why for self-occupied property, we directly arrive at 24B, interest on borrowed capital. So whenever there is an interest paid for SOP properties, you will get loss. Are you following this? Interest on borrowed capital. Okay, first of all, let us go. Municipal taxes. On what basis we take deduction? Payment or accrual? Payment basis. Even if paid of arrears, even if paid of advance. Paid, take deduction. Interest on borrowed capital, exactly opposite. We take deduction only in case of accrual basis. Accrued, take deduction. Paid, not paid, that is irrelevant. So obviously interest of future years or back years, you cannot take them. Accrued, take deduction. Is it okay? Then it has to be actually paid, that also by that owner during the year. Which one? I am talking of municipal taxes, right? Interest on borrowed capital is for which loan? Only for construction, acquisition, repairs, renewal, reconstruction. Only for these purposes you can take interest deduction, right? Then we talk about ceiling limits. Ceiling limits for 24B, interest on borrowed capital. As soon as you assume a house property to be let out or deemed let out, don't look at the ceiling limit, it is unlimited, available. But in case of self-occupied properties, you have to look at many conditions. First one is purpose of loan, also you can say. If it is for repairs, reconstruction, etc., then it is 30,000. If it is only for acquisition or construction, now again we have to see, look at now. Are you following now? If you take for repairs, reconstruction, etc., it is 30,000. If you take for construction or acquisition, you check now what? Date of loan. If it is before, okay, but before 1499 again 30,000. On or after 1499 again you check 2 things. The construction should be completed, construction or acquisition should be completed within 5 years from the end of the financial year in which loan was taken. And plus you get a certificate from the lender. If these 2 conditions are met, 2 lakhs. If again these conditions are not met, 30,000. So for let out or deemed let out, no limit. For SOP there are only 2 limits, 30,000 or 2 lakhs. These limits are also available to co-owners individually. These limits are also available to co-owners individually, or you can say independently. Is it okay? Now we saw a little bit of cases, situations, taxing of house properties. A house property let out throughout the year, no problem. You consider it as let out. Do as the calculations. GAV, NEV, municipal taxes are reduced already. Then deductions of 24A, 24B. Right? A house property self-occupied for the entire year. No problem over there. What will you reduce only? Interest on borrowed capital. A house property let out as well as SOP during the year. You will assume that it was let out for the year. What about deduction of municipal taxes? For the year. Allowed obviously for entire year. Right? So 24A is always 30%. So it is not changing. And interest on borrowed capital now, ceiling limit or no ceiling limit? No ceiling limit, because you assume the property to be fully let out for the entire year basically. Right? Fine. Then there are two house properties. One is self-occupied, one is let out. Same assessee, no problem. For self-occupied, what you can reduce? Interest on borrowed capital to the ceiling limit of 2 lakhs. And another house property, it is let out. Calculate it regularly, no ceiling limit of interest on borrowed capital. Add up both of them. Add up both of them. It can be profit, it can be loss from both the properties. For SOP, if you have paid interest, it will be loss. Add up with the income of let out property. That will be a final figure of income from house property for that particular assessee. Yes? Right? Okay, what else we saw? Co-ownership. There are two or at least two owners to the same house property. Right? Like I said, the interest ceiling limits are available independently to the assessee. Okay? So if it is there is one house property, SOP by both the co-owners, what you will arrive at? Interest on borrowed capital. Again, loss for independent ceiling limits to each assessee. Okay? There is a house property, co-owner and let out. One single house property, there are co-owners and let out. What will you do? First calculate as one house property without bifurcating. Whatever you will arrive at income from that house property, now you divide between the co-owners between their respective ratio. Right? Is it okay? One owner, one house property, portion or part used for SOP, portion or part used for let out. So you will be doing calculation separately, SOP as well as let out, and everything will be now bifurcated, not equally, in the ratio of that, you can say, portion of that let out and SOP. But in SOP, again it will be nil till where? Till 24A, it will be nil. So again for SOP portion, you only have to take interest on borrowed capital. But for let out, you have to do portion right from starting from GAV. Even municipal taxes now you will take their portion, whatever is a part of that let out. Right? Yes or no? Then what else we saw? Arrears of rent. It is an exception. Arrears of rent is an, you can say, exception. It is charged here on receipt basis. Even if it might be rent or income of previous years, it will be taxed in the year of receipt. Are you following? Since you might have taken deduction of Rule 4 unrealized rent in earlier years, now you have received that income, or maybe there was a dispute between the tenant and landlord about enhanced rent. Enhanced, remember? Increased rent. It might have gone into dispute, and that dispute is settled now after a couple of years. That income you received in the particular year, it will be taxed in the year of receipt. Yes? Yes or no? What can we reduce from there? Again 30% standard deduction under section 25A. You arrive at net income. Right? Okay, yeah, important section, yes. For the case of builder. Right? So, builder gets one entire financial year to sell his property. Or basically what does the section talk about? Income from house property or any basically unsold inventory. House property is there, let us say residential flats or shops, etc. It is lying vacant. It is lying vacant for more than 1 year after the year in which construction completion certificate is received. What did I say? Construction completion certificate. So for that particular section, construction date is not important. Construction completion certificate is important. Okay. So in the year in which you received construction completion certificate, that year, plus one more entire financial year, for these two periods you can say GAV is nil. GAV is nil. Even after that period, there is still, you can say, unsold inventory. Now GAV will be calculated. That means now you will assume them to be let out, deemed let out. Are you following? So the year in which construction completion certificate is received plus one entire financial year, GAV is nil. From that period onwards, taxation chalu of that builder as deemed let out. Are you following this? Yes. What else? If that same house property owned by the assessee is also used by himself for his own business, then that entire whatever are the incomes expenditure that do not come in this head of income from house property, that will be taxed or calculated in income from business or profession, right? The purpose of letting out property is not important. The purpose of let out. The property may be let out for residential purpose or commercial purpose by the landlord. Are you following here? Yes? And that was right. And if the company or any assessee is in the business of letting out of properties, that income will not be taxed in income from house property. That income will be taxed in PGBP, profits or gains from business or profession, right? Very good. Understood? Yes? Very good. That is okay. House property not occupied due to employment, or he cannot occupy his own house property, or and then he stays in some other property which is not belonging to him. That is number one. And secondly, he is also not deriving any income or profit from his own house property. In that case, his own house property's GAV will be nil, right? Good. वो तो रह गया ना. Pre-construction period. We get interest on borrowed capital. How do we calculate pre-construction period? From the date of disbursement of loan to earlier of date of repayment of loan, or 31st March preceding the date of construction. Over there we use date of construction. That is your pre-construction period, right? What do we do of that? So we basically first of all calculate pre-construction period. Then we calculate pre-construction interest. For that period, calculate the interest, and whatever interest is there, you take it as now 1/5 from the year in which construction is completed, isn't it? From the year in which construction is completed, 1/5 every year consecutive. Is it clear? Yes. So the year in which construction got completed, you can get two types of interest deduction. One is current year interest, and second is pre-construction interest, right? Very good. What else? And what else we have seen? Income ancillary to main business, income from house property, which was ancillary to the main business of the assessee. That income is business income. Very good. It is not income from house property. Which example we saw? Worker colonies rent income, nominal amount received. That was related to the main business activity. So even this will be now absorbed in the main activity. Understood? Income, right? Yes, everyone. Or kuch? Yes. House property location is not relevant. Basically, if the assessee is resident, if the assessee is ROR specifically, his global income is taxable. So for an ROR, resident and ordinary resident, even a house property situated outside, accrued outside, still it will be taxed in India, right? Again, and we have to do that calculations of if you have two house properties, two or more, you have to consider one as SOP. So again, you can take outside India property also as SOP or vice versa. Are you following? But in a non-resident's case, house property also situated outside India. In that case, it is not taxable in India, except it was received in India. So in that case, you have to see accrual or receipt, where it is getting generated or where it is getting received. If any of this is in India, it becomes Indian income, it becomes taxable for ROR, RNOR, NR. Yes. Fine? Okay, one head of income done. Understood?